Hey traders, welcome back to TradeX Pro. In this episode, we're diving into one of the most exciting aspects of technical analysis, the chart patterns. Last time, we broke down 9 key candlestick patterns, exploring how and when to use them and their impact on market sentiment. Today, we're shifting our focus to the bigger picture. Whether you're spotting a breakout, anticipating a reversal, or riding the trend, these patterns are your roadmap to making informed trading decisions. From the classic double top to the powerful head and shoulders, we'll explore the patterns that traders rely on to navigate the markets with confidence. Let's jump right in. For those who missed the last episode, here's a quick recap. Candlestick patterns generally focus on short-term price action, typically consisting of 1 to 3 candles. These patterns are designed to capture quick shifts in market sentiment and indicate potential price movements over a short period. Chart patterns, in contrast, provide a broader view, often unfolding over 10 or more candles. These patterns form distinct shapes on the chart, revealing underlying market psychology and indicating potential long-term trends or reversals. By analyzing these patterns, traders can gain deeper insights into market behavior, helping them make more strategic decisions over extended time frames. Chart patterns come in a variety of forms, each with a unique name and significance. These names help identify the patterns and provide insights into their likely impact on price action. By recognizing these patterns, traders can quickly gauge potential future market movements and adjust their strategies accordingly. Traders often categorize chart patterns based on their potential outcomes: reversal, continuation, or both. Reversal patterns like the triple bottom or head and shoulders signal that the current trend may be ending and could reverse direction. Continuation patterns such as ascending triangles and flags suggest that the trend is likely to persist after a brief consolidation. Some patterns, particularly symmetric ones, can lead to either a reversal or continuation. To make better trading decisions, traders should pair chart pattern analysis with additional tools, like price action, for a more accurate market view. For today's episode, we'll concentrate on reversal chart patterns: double top, double bottom, triple top, triple bottom, head and shoulders, and inverse head and shoulders. These patterns signal potential changes in the direction of the current trend, helping traders anticipate market shifts and make informed decisions. We'll explore how to identify these patterns and what they can reveal about future price movements. Let's start with number 1, double bottom and triple bottom. These patterns are very similar, with the main difference being the number of troughs. The double bottom pattern is characterized by 2 distinct troughs at roughly the same price level, separated by a peak. The troughs represent areas of support, formed after the price declines and then rebounds. The peak between the troughs is known as the neckline. It represents the resistance level where the price encounters a temporary obstacle before potentially breaking out. Trading opportunities often arise after the second bounce from the support level, as traders look to enter positions once the price forms the second trough. Similarly, the triple bottom pattern features 3 distinct troughs at roughly the same price level, separated by 2 peaks. This pattern indicates that the price has tested the support level more times than the double bottom, suggesting a greater potential for a trend reversal from bearish to bullish. Trading opportunities often arise after the third bounce from the support level, as this confirmation increases the likelihood of a trend reversal. As you can see from the shape, both the double bottom and triple bottom patterns indicate a potential reversal from a downtrend to an uptrend. Although these patterns are generally easy to identify on charts, they can occasionally appear noisy and imperfect. Traders should make a rough estimate and consider the pattern even if it isn't perfectly formed. Generally, there are different strategies for entering trades with these patterns. The first is an aggressive entry, made right at the support level where the price bounces off. This approach carries higher risk but offers the potential for greater returns. The second entry point, known as the neckline entry, occurs when the price breaks above the neckline. This break confirms the pattern and indicates a stronger likelihood of a trend reversal from bearish to bullish. As a widely used strategy, the neckline entry point provides critical confirmation for traders looking to enter a long position. The third entry point involves waiting for the price to break above the neckline, then pull back and retest it. This retest confirms that the price is unlikely to fall further and strengthens the indication that the trend is reversing. However, this approach can be slower and may offer lower rewards compared to the more aggressive entry points. Let's review an example. The price initially falls sharply but then slows down after the first test of the support level. Following the second test, the price begins to reverse upward. A small peak forms the neckline, completing the double bottom pattern. Traders should wait for the price to break above the neckline before entering the position. Next example. The price declines and tests the support level twice. On the second test, a long wick candle forms, suggesting potential upward momentum. We can choose to enter a long position after the price breaks above the neckline. Alternatively, we might wait for the price to pull back to the neckline, retest it, and then bounce upward. If the price makes a new high after the pullback, that could be a signal to enter the trade. Similar to the previous example, the price drops and quickly rebounds, but strong selling pressure pushes it down again. This time, the price enters a consolidation phase due to market indecision before eventually deciding to rise, forming a double bottom pattern. We can either wait for the price to break above the neckline before going long or opt to wait for a pullback. After the price retests the neckline and reaches a new high, that could be our signal to enter the position. In the final example, we observe the triple bottom pattern. The price drops and tests the support level 3 times, rebounding each time and reinforcing that support. Two small peaks create a minor resistance level known as the neckline. After a powerful upward move highlighted by 4 momentum candles, the price breaks through the neckline, signaling an opportunity to enter a long position. Next, let's explore the second group of chart patterns, double top and triple top. These patterns are essentially the inverse of the double bottom and triple bottom. The double top pattern features 2 prominent peaks at nearly the same price level, separated by a trough. These peaks represent resistance levels, where the price rises, then pulls back. The trough between them forms the neckline, acting as a support level that the price tests before potentially breaking down. Trading opportunities typically emerge after the second peak, as traders often enter positions when the price begins to retreat from the resistance level. The triple top pattern is an extension of the double top, characterized by 3 peaks at similar price levels, separated by 2 troughs. Each peak represents a point of strong resistance where the price fails to break higher. The repeated inability to surpass this resistance signals increasing selling pressure. The troughs between the peaks form a support level, or neckline, which acts as a critical point for traders. Trading opportunities generally appear after the third peak, as traders often consider entering positions when the price begins to fall from the resistance level. Like the double bottom and triple bottom patterns, the double top and triple top are used to identify trend reversals. In these cases, the patterns signal a potential shift from an uptrend to a downtrend. One challenge with these patterns is that, while they are usually straightforward to spot, they can sometimes appear noisy or imperfect. Traders may need to make a rough assessment and use the pattern even if it doesn't fit the ideal shape perfectly. There are 3 entry points for traders to consider. The first is to enter at the resistance level, which offers high reward but comes with higher risk, as the price might not fall as expected and could potentially break through the support and continue rising. The second entry point is more conservative, waiting for the price to make a new low, which indicates that the trend has shifted and provides a clearer signal for entering the trade. The third entry point is the most cautious. Traders wait for the price to break below the neckline and then retest it. Once the price fails to make new highs and starts to decline, this retest provides a safer entry point, as it confirms the trend reversal and suggests a downward move. In this example, the double top pattern is clearly visible. The price rises and pulls back slightly, then climbs again for a second peak. This time the momentum is insufficient to sustain the upward movement, and the price reverses at the resistance level. A long upper wick candle at the peak indicates strong selling pressure. Once the price falls and breaks below the neckline, it signals an opportunity to enter a short position. Another example illustrates the double top pattern in a similar manner. The price rises towards the resistance level on 2 occasions. Each peak features long upper wicks, signaling that sellers are dominating. Once the price drops below the neckline, it begins to move downward, validating the trend reversal and presenting an entry point for a short position. As mentioned earlier, patterns can sometimes appear imperfect. In this case, we see the triple top pattern. The price rises and reaches the resistance level 3 times. Although the peaks may not be perfectly aligned, and there could be some minor variations in height, the pattern still indicates strong resistance. Each peak is accompanied by long upper wicks, showing persistent selling pressure. We have 2 scenarios for entering the position. The first is to enter right after the price breaks below the neckline. The second is to wait for a pullback and retest of the broken neckline before entering. The retest can provide additional confirmation of the trend reversal. Our third chart pattern for this episode is the head and shoulders. While it may look similar to the triple top, it has a very distinct interpretation. The name comes from its distinctive shape, resembling a head and 2 shoulders. As shown on the right, the first peak forms the left shoulder, followed by a higher peak that forms the head, and finally a lower peak that forms the right shoulder. The line connecting the shoulders is the resistance level, while the line at the troughs is the neckline. This pattern signals a weakening trend, where the price fails to make new highs and begins to reverse downward after forming the right shoulder. Traders can enter the trade after the price bounces from the resistance, similar to the approach used with the triple top pattern. Both the triple top and head and shoulders patterns signal a trend reversal from an uptrend to a downtrend, but many traders consider the head and shoulders to be more robust and reliable than the triple top. Here's why. The strength of the head and shoulders pattern lies in its structure. Let's examine it from a market activity perspective. Initially, the price is low, attracting buyers who see it as a bargain. As the price rises, some sellers begin to offload, thinking it's reached a good value, causing a minor pullback. However, buyers push the price higher, hoping for further gains. When the price hits a new peak, another wave of selling occurs. After this, buyers attempt one last push, but they fail to reach a new high. At this point, selling pressure intensifies as sellers, fearing further losses, rush to exit their positions. This panic, coupled with short sellers entering the market, drives the price down even faster, leading to a significant downturn. Similar to the triple top pattern, traders may consider entering the trade at these points. Right at the resistance, after the neckline break, or after the pullback and retest. Note that the risks associated with trading the head and shoulders pattern are generally lower than with other trend reversal structures because its distinct formation provides a clearer signal of trend weakening, and the pattern often offers more reliable confirmation of a downward reversal. Let's look at an example. Here, the price first rises and hits a resistance level before pulling back. It then climbs again, surpassing the previous high, which initiates the formation of the head and shoulders pattern. The pattern completes with another rise, forming the right shoulder. The neckline is drawn by connecting the lows between the shoulders and the head. Once the price breaks below this neckline, it indicates a potential opportunity to enter a short position. Similarly, in this example, you can observe an imperfect head and shoulders pattern, where the 2 shoulders are not aligned at the same level and the neckline slopes downward. Traders should be prepared to wait longer for a clearer breakout, as the entry point may occur further down once the price breaks below the tilted neckline. Sometimes, a tilted neckline can actually be advantageous. In this example, a classic head and shoulders pattern forms, but the neckline is tilted upward. This tilt provides a more favorable entry point when the price breaks below the neckline. In the fourth example, the head and shoulders pattern is clearly visible in the middle. To the left, you can see a consolidation period that acted as a previous resistance. The price then breaks this resistance, retraces to this level, and treats it as support. This resistance to support level becomes a key level for traders. A break below this key level signals a potential entry point, and if the price subsequently pulls back to retest this level, it offers a safer entry opportunity. This final example is quite intriguing. The chart shows a classic head and shoulders pattern with a slightly tilted neckline. Traders can enter a short position once the price breaks below this neckline. However, for those willing to take a more aggressive approach, entering near the right shoulder could potentially yield higher rewards. To do this, traders should switch to a lower time frame and look for additional signals to confirm their entry. Let's zoom in. On the left, the one-day chart displays the head and shoulders pattern discussed earlier. To target an entry point at the right shoulder, we zoom into the 2-hour chart for a more detailed analysis. On this smaller time frame, the right shoulder reveals an additional head and shoulders pattern within the larger pattern. By identifying and drawing the neckline of this smaller formation, we find a precise entry point for a short position. This entry point aligns with the yellow marker on the one-day chart. This strategy allows for a quicker and potentially more profitable entry by utilizing the internal pattern to time the trade more effectively. Our final trend reversal chart pattern is the inverse head and shoulders. As the name suggests, this pattern is essentially the reverse or upside-down version of the classic head and shoulders. In this pattern, the peaks and troughs are inverted, indicating a potential shift from a downtrend to an uptrend. Traders can look for entry points similar to those in other patterns, entering at the breakout of the neckline for a safer approach or taking more aggressive positions at earlier stages of the pattern. As with other patterns, the safer entry usually offers lower rewards compared to the riskier ones. On the real chart, the price initially rises and then undergoes a significant pullback. During this pullback, an inverse head and shoulders pattern emerges. Two minor peaks in the pullback create a neckline, acting as a minor resistance level. Traders can wait for the price to break above this neckline before entering the trade. This strategy shows how a reversal pattern can be effectively used within a continuation trend, allowing traders to capitalize on the pullback as it reverses and aligns with the original trend. In this example, the price steadily declines and then forms an inverse head and shoulders pattern with a standard neckline. Traders have two options. They can enter a long position as soon as the price breaks above the neckline, following the traditional method. Or they can wait for a pullback to the neckline for additional confirmation. Here, the price hesitates slightly around the neckline before resuming its upward movement. Once the price reaches a new high, it offers a more secure entry point for the trade. Moving on to the next example. In this case, the inverse head and shoulders pattern isn't perfect. The shoulders are misaligned and the neckline is tilted. Despite these imperfections, the same trading strategy applies. One option is to enter the trade after the price breaks above the tilted neckline. Alternatively, for a more cautious approach, traders can wait for the price to pull back and retest the neckline. Once the price establishes a new high, signaling a confirmed trend reversal, it offers a reliable entry point. In our final example, we see a similar scenario with an imperfect inverse head and shoulders pattern that spans across many candles. The neckline is tilted upward, extending toward the pullback level. Traders have a couple of options. They can enter a long position after the price breaks above this tilted neckline, or they can wait for a pullback to the neckline for additional confirmation. For a more conservative approach, traders might choose to enter only after the price establishes a new high, ensuring the trend reversal is solidified. To wrap things up, we've covered some of the most effective trend reversal patterns, including the double top, triple top, double bottom, triple bottom, head and shoulders, and their inverse variations. These patterns offer valuable insights into potential market reversals, helping you time your trades more effectively, whether you prefer early entries or waiting for solid confirmation. In our next episode, we'll dive into trend continuation patterns, which will guide you in spotting when a trend is likely to resume after a brief pause. Stay tuned for that.